Andy Starks, Director at Alithia, will walk through investing in your own bank's future with effective strategic planning. Please feel free to ask any questions you may have in the Q&A chat, and the team will reach out to address them after today's presentation concludes. And with that, I'll pass things over to Andy now to get us started.
All right, thanks, Mary. Good afternoon, everybody. My name is Andy Starks. I'm Director at Alithia. I've been with Alithia for about 14 years, and I've been working in the Oracle EPM space for over 20 years. And all of that time has been focused around helping companies implement effective strategic plans or long-range plans. So I've worked with over hundreds of companies, specifically using strategic modeling, Hyperion Strategic Finance, and other Oracle tools to build out strategic plans. In addition to that, also do some blogging, some webinars. So here are some links to those that you can access there on our website if you choose to peruse those at a later point in time. In case you don't know who Alithia is, we are a publicly traded company. We're based out of Montreal, Canada. We're traded on the Toronto Stock Exchange. We have 4,000 employees. We've done projects at over 1,000 clients, spanning 3,000 projects, 700 of which are in cloud. So really the last 5 to 10 years, we've been focused primarily on cloud. We've been in business for over 25 years, and we have over 350 Oracle consultants around the world. Most of those are based in the United States and Canada. And we have 8 Oracle Aces, which is the highest designation an individual consultant can get within the Oracle ecosystem. In terms of what we do, starting here in cloud applications, we help companies build ERP systems, human capital management systems, and enterprise performance management systems. And so the demo I'll be doing today on strategic modeling fits within the EPM side of our business. We also do technology services and provide advisory services. Okay, so today is the third in a series of 4 webinars we're doing on our capabilities around banking. Feel free to, there's some QR codes here that will take you directly to YouTube's site if you're interested in checking out some of the previous webinars that we've done. We did one on bank margin planning back in October, did another one last month on connected planning for banks. Today we're focused on strategic modeling for banks, and then next month in April, we're doing one on profitability for banking. So in terms of the learning objectives and agenda for today's session, I want to first talk about what is Oracle EPM strategic modeling and give a little context for where that fits within Oracle's EPM solution. We'll talk about some specific use cases of strategic modeling for banking and how we've seen that used in the industry. And then we'll do a demo of Oracle strategic modeling. So I'll spend the bulk of the time demonstrating some capabilities of the tool that are effective and useful in terms of producing a strategic plan. And then we'll conclude with some wrap up. All right, so strategic modeling is part of Oracle's EPM solution. EPM, or Enterprise Performance Management, is a suite of cloud tools that are used to support the office of the CFO, and it really spans, a variety of different functions within finance. So it's, the planning process, FP&A, doing the budget, the forecast, the long-range plan, the close consolidation process, analytics and reporting, using machine learning and AI to outperform with that type of intelligence, and then aligning enterprise data using metadata management tools to streamline your organization. So all of these different tools are part of Oracle's EPM platform. It's all in a common platform. It's been around for many, many years. Obviously, the cloud component of it is new, but many of these capabilities that we're talking about had on-premise alternatives dating back for many years prior to this. You can deploy these at your own pace according to your own needs, and there definitely is a lot of out-of-the-box best practice content that you can leverage from day one. All right, so within EPM, we're going to focus on planning, and specifically we're going to focus on strategic modeling and long-range planning. So the earlier sessions that we did, we focused on some of the operational plans, building up a financial plan, workforce plan. Today is going to be focused on long-range planning or strategic planning. So where does strategic modeling fit? I like to look at it in terms of this axis, flexibility versus control. And so on one hand, ultimate flexibility, you have spreadsheets. You can do whatever you want with spreadsheets. You can make it as simplistic or as detailed and complex as you want. And they're really, there's no controls around them, right? So you can build things up quickly. The downside is they oftentimes get unwieldy, they get overgrown and overbuilt, and there tends to be a lot of errors and issues with version control and things like that. On the other side of the spectrum, you have predictable control. So when you think about your bottoms-up budget process, you need a lot of controls around that. That's often getting deployed to the masses. You might have dozens or hundreds of users across your enterprise that are contributing to the budget process. And you need to have controls. Not all of those people are savvy in finance or really understand how to use the tool. So there's tends to be a lot of security set up around it, a very controlled process. In the middle of those two is strategic modeling. So it is built for speed. It is meant to be agile. It is meant for end users to be able to flexibly add new scenarios on the fly and make changes. But there also is an IT backbone around it. There's version control. It's in the cloud with a system that has backups. You're able to automate integrations. So it's really kind of blending the best of both worlds and giving you both speed and control in your strategic planning process. All right, so in terms of banking, some of the typical use cases we've seen in banking and financial institutions for strategic modeling. First, I'm going to start with strategic planning. So building out a long-range plan, typically going out 3 to 5 years, sometimes 10 years into the future. Because of that higher level view, it tends to be more strategic, directionally correct in nature. We're not going down to the lowest levels of the organization, and we use a driver-based approach to modeling. So we're looking at higher levels of account detail, higher levels of entity detail, and what are the key value drivers that really move the needle and impacts your financial statements. It does come with out-of-the-box integrated financial statements, so goes beyond income statement, has balance sheet, cash flow. A lot of those. That accounting intelligence is pre-built, which is nice. It gives you that level of control again over the output. But it is geared towards on-the-fly modeling, so you can spin up new scenarios, you can add new metrics, new drivers as you go, change forecast methods, and I'll highlight some of that during the demo today. Over here in risk management, we have companies that use it to manage risk across their organization. So it might be, the enterprise risk management team, or it might be FP&A that's tasked with modeling out some risk metrics, whether that's RAROC, capital tiers, economic capital, risk-weighted assets, being able to bring those into your planning process, apply economic shocks, scenarios, and sensitivities, and understanding when you might be at risk and when you might need to raise capital, and then evaluating different risk mitigation strategies to handle that. On the treasury and capital structure side, it's really looking at cash flows and forecasting those out across the organization. So having a very accurate cash flow and then being able to make decisions off of that. So whether you need to raise capital, issue debt, equity, or model share repurchases. Those types of capital structure decisions can be made easily in the tool with the funding options that comes out of the box, along with the scenario modeling capabilities. And then also being able to model any covenants or credit ratings, so you can see how you're performing against that. And as you're looking at different strategic alternatives, if that might impact you getting downgraded or breaking a covenant, you have line of sight into that. And then finally, over here, scenarios and sensitivities, just being able to sensitize any aspect of your business, whether it's interest rates or loan volumes, charge-offs, being able to see as you move those parameters, what the flow-through impact is, not only the income statement, but also balance sheet, cash flow, and some of your key metrics. So all these disparate modeling activities, sometimes they're done in Excel. It's suboptimal for a lot of the companies we work with, and they're looking to get something that's more structured, that has an IT backbone and some controls around it, but still giving users the flexibility to be able to model things quickly and with a lot of agility. All right, so backing up some of the scenario capabilities that I just talked about, there's a number of out-of-the-box capabilities with the tool, and I'll demo this scenario manager that's being able to sensitize any variable within the model. Business cases, that allows you to look at consolidation scenarios. So what if we acquire this company? What if we divest this business? What if we look at these strategic initiatives and want to layer those into the consolidation structure? We can easily see the pro forma impact of those business cases. You can also do goal seeks and sensitivity matrices within the tool, as well as Monte Carlo simulations. Okay, so with that, I'm going to transition into the demo, and I'm going to move over here into the web, and I've got my EPM Cloud Planning instance. So we did additional sessions earlier, so you can see some of the financial planning. Again, this is more for your forecast process, your bottoms-up plan process. We have compensation planning, margin planning. This is another one of the webinars that David and Misha did. Today, we're focusing on strategic modeling. Again, all of this can sit within the same pod, within the same instance, and then we can access it based on what type of business process we're looking to affect. So for strategic modeling, I'm going to start out here at scenario rollups, and I'm going to open up my consolidation structure. So this is, again, how the strategic plan is being built up from an entity perspective or from a model perspective. So here within this bank holding corp, we have various divisions that roll up into it, but then we also have strategic initiatives and target acquisitions that we can layer in. And then we have the ability, you notice that this is included or excluded, I should say. You can easily right click, decide if you want to include or exclude something, and run a consolidation with and without. And so we have different business cases that control that. So existing business, we can define that. And then maybe for my baseline, we want to include all those three elements. And then we can, as we run consolidations and we're doing reporting, we can easily isolate the pro forma impact of a strategic initiative or an acquisition on our consolidated financial statements. Okay, I'm going to open up one of the models now, and we can take a look at some of the modeling functionality within there. So I'll open up this bank holding corporation. All right, so it's opening up to my accounts view tab. You'll notice there's different reports across the top. We'll get to those in a little bit. The accounts view tab is where all the individual input assumptions are within the model. And this is where we can make changes to those inputs. We can also change the forecast methods here. And we can navigate to the section of the model we want to work with by clicking this drop-down box under account groups. So right now I'm in my income statement account group, but if I wanted to hone in on my yields, for instance, or my interest income, I could go there. If we want to look at our balance sheet and maybe look at our bank assets, I can go to that section, and it's going to bring up that listing of accounts. So this is the main navigation tool from the accounts tab perspective. We go back to the income statement view of things. If we make a change to the model, let's say I want to change my FTP percentage for commercial loans from 3% to 2%. I can change it. You'll notice it's the color coding there. When I calculate the model, it's actually going to show me all the dependencies of that change. So I can see the outputs there. And as I scroll down this account group, I can see that my yield has been impacted by the FTP percentage. I can see that the FTP cost is impacted. I can see my interest income is impacted, and so on and so forth down the P&L. You can get a nice visual trail of anything that's impacted by an individual input change, all the way down to net income and any of the ratios we might be looking at. Okay, you can also drill back the other way. So if I want to look at, well, how is this interest income on commercial loans calculated? I can click on that output, click on Actions, and then click on Audit Trail. And it's going to bring up a worded description that shows me, okay, this is calculated taking my asset balance for commercial loans, multiplying that by the yield of 5%, and then there's some day weighting going on here. And I can drill back through this. If I want to drill through my yield, I could drill back to that FTP percentage that I previously changed, and I can modify that directly here and then run that back through the calculation logic. And so that's true. You can do that on this Accounts tab. You can also do that on any of the reports. So if I'm on my income statement and I want to see how an output has been derived, let's say I want to look at my net interest income less provision in May of 24. I can click on that, and you see over here that it's updated now to show me that it's taking net interest income, less my adjustments, less my provision for loan loss. And I can continue to drill back through that underlying logic and see how that might change. So if I go into interest income, and then I'll go to interest income for loans, and then I can go into my consumer loans and see that it's taking the asset balance times the yield. If I want to go into my asset balance on that, I can change the underlying growth rate. So here we're forecasting our loan growth. And so if I want to change that to 1% for that month, I can do that, calculate the model, and it's going to ripple through, and you'll see that 797 now has changed slightly to 798. So that whole trail that we just traced through is available to me. I can go to any spot within this analyze trail and see exactly how that change has impacted that particular line item. So you have really good visibility into the underlying calculations, whether you're a new user or you've been using it for months or years. You can immediately click on a cell and see what the calculation for that is and really understand how the underlying model is being built up. Okay, so we do that. We've forecasted out income statement. As I mentioned, balance sheet, cash flow. We have out-of-the-box integrated financial statements within strategic modeling. And what we're doing then in the implementation process is configuring the accounts and the reports to match your specific business requirements. But in this case, we are forecasting out our loan balances and our other assets, and then that's driving the net interest income calculations on our P&L. All right, so again, we can click on any of these values and see the flow through changes to those. The other capability you have with strategic modeling is to do scenarios. So I talked about that earlier in the slide portion. I'm going to create a scenario. So I'm going to come over here to the scenario comparison report, and we're going to create a new scenario. We're going to drop it into these rows over here, and then we can calculate the variance against our base case. So to create a new scenario on the fly, it's quite easy to do. We just click on Actions, Scenario Manager. And I'm going to hit the plus button right here. And I'm going to give it a name. So let's say we just want to create an upside scenario. And I could have it be a standalone scenario that we kind of create from scratch, from the ground up. Usually much more efficient to have it inherit the values from an existing scenario. And then by exception, tell it what values we want to sensitize or what values we want to be different. So I'm going to have it inherit the values from the base case. And then I'm going to come over here and specify the specific accounts that I want to sensitize. So let's say we're looking at higher loan growth across our loan portfolio. So I'm going to type in commercial loans and grab that one. And then I'm going to grab my consumer loans. And I'll grab my mortgages too. And then let's say we want to look at potentially reducing our provision for loan loss. I think we can tighten that up a little bit, so I'll select that as well. So out of all the accounts in the model, I've selected those 4 accounts to be unique, independent from the base case, so we can go in and sensitize those values. Everything else will retain the values from the base case, and then we can run that through the calculation logic of the model and see how that impacts my key outputs. So I'll click Save and Close, and now it's creating that scenario in the background. And I can now toggle down to it in my scenario drop-down box, refresh this report. And you can see right now we have zeros for my upside case. It's just because I haven't input any values. I haven't calculated the model yet. So we'll go do that right now. I'm going to go back to my Accounts View tab. And in my Accounts View tab, I have a dynamic account group called Current Scenario Only, which is going to show me just the accounts that are current and active for this given scenario, in this case, the upside. And you can see it winnows it down to just those 4 accounts. So now I can go in here and make some adjustments. It has dropped in the base case values to give me a guidepost. So I know, what we originally had assumed for that, and now I can adjust it how I see fit. So in the upside case, let's say we think we can grow our commercial loans by 4% instead of 3%. So I'll just type that in there, drag that across. We'll do commercial loans at 7% growth. And we'll do mortgages at 5% growth. And provision for loan loss is set up as a percent of my total gross loans. So right now, we're saying we're 2% is what we're projecting in terms of our loan loss. Let's say we think we might be able to shave that down to 1.5%. Just going to drag that across for simplicity here. So now that I've made those changes, I'm going to calculate my model. And it's calculating through all the outputs. So now I can go back to my scenario comparison report. And we can see base and now upside, these columns are populated. And we can see the differences over here in the variance columns. If we look at like our interest income for loans, that's going to change because we've increased our loan balances. So we're earning additional income then as a result of higher loan balances. If we look at our provision, which is down just a little bit lower, you can see the provision for loan loss here has been adjusted so that is going down. And then the net result, if we scroll all the way down to the bottom, we can look at how that impacted operating income. Let's see, there was 734 here versus 8348 there. So that's resulted in about $1 billion in incremental operating income by the last year of our strategic plan. So you can easily create these scenarios on the fly. It took me a couple minutes to create that and then run it through the model and see the results across any of your statements. So this is a scenario comparison against the income statement. We can do that against any type of report we want or any type of output. If I come over here to the capital adequacy analysis, we can take a look at how our Tier 1 capital looks. This is currently the upside case. Our Tier 2 capital, our risk-weighted assets. We can see our capital adequacy ratios here for Tier 1 and Tier 2. So again, I could take a look at this 12.35 in 2027, and you can see it's 12.35. I can flip it to the base case and see what it is there. You can see it's 12%. So we picked up about 35 basis points on our capital adequacy ratio for Tier 1 in the upside scenario. So you can either, hit the drop-down box, interact with it that way, or you can create scenario comparison reports that allow you to see side by side the differences of these accounts. Okay, so that's the scenario manager capability of strategic modeling. The other thing that I want to show you guys is the ability to run Monte Carlo simulations. So if I come back to my accounts tab, I'm going to go back to my income statement view. And so Monte Carlo simulations, I'll walk through exactly what that is here in a second. But to activate it, I'm going to click on simulation here from the action menu. And I have this preloaded already just to kind of save time. But it's really easy to set up too. So as I scroll down, you're going to notice there's green shading around commercial loans. Commercial loans is forecast as a growth rate, 3% growth. If I click on that, the green shading implies that there's a distribution curve assigned to that. So instead of forecasting in specific points, like we think it's going to be 3% growth, or I ran an upside where I changed it to 4%. The reality is, no one really knows what the growth is going to be, or knows definitively what it's going to be. So sometimes it's better to forecast in ranges. And so Monte Carlo simulations allows you to put ranges around uncertain variables, and then we run thousands of trials or simulations through the model, and we can see how that impacts and what the dispersion of results is across some of our key metrics like net income or RAROC or anything else we use to measure our business. So I've set this up using a normal distribution curve, mean of 3, that's the base case value, standard deviation of 1. And so if we run 1,000 trials through this, it's going to primarily pick values kind of between 1.5 to 4.5%. But we will get some values in the tails, and we can see if we get 0% loan growth or 5% or 6% loan growth, what impact that has, what kind of net income we get in those outlier situations. So I've set that distribution curve up there. As I scroll down a little bit further, you'll notice my provision for loan loss. I've set that up to use a triangular distribution curve. So this is simple as well. We just put the likeliest, which is our base case value of 2%. And then we just tell it what the minimum and the maximum is. So maybe we think the minimum we would see is 1% provision. And then if there's, some kind of economic shock or recession, maybe we could go as high as 5%. And so we can just input that, whatever it is, it's going to draw the triangle. And again, if we do 1,000 trials, it's primarily going to pick at the peak of the triangle, but we'll get some out at 5% or at 1%. We can see how that impacts the model. And then lastly, what's the variable we care about that we want to measure? So it could be any, or you could pick multiple variables. For this example, I've picked net income. And so it's going to show us what the base case net income forecast is. And then it's also going to calculate for us worst case and best case at the 5th percentile and 95th percentile. We're going to capture the mean. We can put a target in there. In this case, I've got a target of 6 billion. We're at 5.4 right now, so that's kind of our stretch goal. And then we can put in different percentiles. So I've got a 20th percentile and an 80th percentile, and we can continue to add additional percentiles and metrics to this. So once I've set all that up, the last thing I want to do is just tell it how many trials I want to run. So I'm going to come in here to settings, and I'll set that to 1,000. And then I can hit this play button, and it's going to launch it. And what it's doing now is it's calculating simulations. So you can see it's already run 80 trials, 100 trials. That means that it's taking inputs that fit within those distribution curves, dropping them into the model, calculating it behind the scenes, and then plotting the result on this histogram of where net income is going to fall. And then we can see the dispersion of what that looks like. So if we look at just worst case, best case, 5th percentile, 95th percentile, we're between about 2.3 million and 6 million. Actually, this is in billions. So 2.3 billion and 6 billion. We can look at our mean, what is expecting it to actually arrive at. That's at 4.5 billion. We can look at our target net income, and it's going to tell us what the certainty of achieving that is. So you can see it's only about a 7 or 8% chance that we get our target net income of 6 billion. So pretty low likelihood of that. But that can be useful if you're giving EPS guidance or anything of that nature, where you can set, what your certainty is and, provide probabilistic guidance around that, giving some cushion for things. So as I click on these different metrics, you'll notice the bars change, and it's going to show me exactly what the probability is of our net income at different percentiles. So it just gives you a much more robust way of forecasting, introducing some statistical rigor to the process, and allowing you to forecast in ranges, especially for those variables that are really uncertain that you have no control over within your business. Okay, so with that, I'm going to wrap up the demo portion. and flip back over to the slides, and we're going to wrap up. Thank you guys very much for joining. Mary, over to you.
Thank you, Andy. This concludes today's webinar. We thank you all for attending, and please check out our website and follow us on LinkedIn at Alethea Digital Cafe to stay up to date on our upcoming webinars, events, and more.